Good day, student. I'll be taking you through Accounting 302, Cost Accounting 2, Study Section 10, Management Control Systems. Learning outcome for Study Section 10. On completion of this, students should be able to discuss the meaning and the importance of management control system, should be able to explain transfer pricing, should be able to discuss the perspective and application of balance scorecard, should be able to explain the meaning of investment center performance. Management control system techniques, or let's define management control system, is an integrated technique for collecting and using information to motivate employee behavior and to motivate performance. Management control system use many techniques, which includes activity-based costing, balance scorecard, benchmark and bench trending, budgeting, capital budgeting, just-in-time EIT techniques, Kaizen, that is continuous improvement, program management techniques, and target costing. Of course, we can have total quality management. We have transfer pricing. Transfer pricing is the method used to sell a product from one subsidiary to another within a country. It impacts the purchasing behavior of the subsidiary and may have income tax implication for the company as a whole. Objective of transfer pricing. The strategic objective of transfer pricing fall into three categories. We have taxation related objective, we have internal management oriented objective, we have international or operational objective. Method of transfer pricing. We have several methods of transfer pricing, but for the purpose of this study, we'll be point picking on the listed one. Market rate transfer pricing, that's one. Adjusted market rate transfer pricing, two. We have negotiated transfer pricing, we have contribution margin transfer pricing, we have cost plus transfer pricing, we have cost based transfer pricing, and we have comparable uncontrolled price. What are the perspectives of BXC? The BSC assess performance from four perspectives. Namely, we have financial perspective, we have customer perspective, we have internal business process perspective, we have learning and growth perspective. From the balance scorecard, the challenges of balance scorecard, which we refer to as BSC anyway, there are many issues surrounding the use of a balance scorecard in organizations. One issue that seems to be of a big concern, especially when an organization decides to adopt this model, usually occur during the implementation stage. Another main problem with the balance scorecard is that it does not provide practical guidance for deployment, and that implementing balance scorecard is an evolutionary process and not a one-time task with efforts to commit for the long time. Reason why balance scorecard failed. Some of the reasons why balance scorecard is not too much failed or ineffective is that it has a poor defined matrix, lack of efficient data collection and reporting processing, and of course lack of formal review structuring or structure in an organization, and no process improvement methodology. And I think when there's too much of internal focus, it have effect on the balance scorecard to function appropriately. We have investment center performance, and if we want to talk about investment center performance, we'll be talking about two major important things. And the first one is profit center, the second one is investment center. Profit center is an organization unit that is responsible to top management for some measures of its own profitability. In measures like net income, pre-tax income, or net contribution. Revenue measures the output, the unit output, expenses measures its input, and profit measures its excess of revenue over expenses. And we have investment center. is an organization unit responsible to top management for its profitability in relation to the unit's own investment base. And we have revenue and expenses are measured as in profit centers, but in investment centers, the assets employed are also measured together with revenue and expenses. Though an investment center is an extension of the profit center, so profit is measured for both, but only in an investment center is this profit related to the size of the investment base. And we have return on investment rate, which is equal to controllable, that is traceable profit, divided by controllable traceable investment multiplied by 100%, and you get the return on investment. For residual income, we have controllable, that is traceable profit, minus an imputed interest charge on controllable traceable investment. I think we have come to the end of this study section, and hope to see you in the next class.